2022 was a historic year for the United States. The US dollar strengthened against nearly every other major currency to levels not seen in decades. Last year, as a world's reserve currency, the US dollar status was labeled as the ultimate safe haven, crushing rivals gold, the Swiss franc, Japanese yen, and Bitcoin. As the Federal Reserve raised rates to fight inflation, overseas investors piled in, seeking a higher rate of return, driving the US dollar to a 20-year high. However, as September approached its end, a change in sentiment swept through the market. The Federal Reserve signaled a shift in its monetary policy, opting to slow down the rate at which interest rates were being raised. This shift had a profound impact on the economy and ultimately changed the trajectory of the US dollar for the worse. Now many are wondering, could the US dollar collapse? It is certainly a big question, especially as the Federal Reserve announced its FedNow service, which will begin operations in just a few weeks. If you are from Argentina, Venezuela, or Russia, you understand the realities of what can happen when your home currency fails. It is a big deal, and it can cause immense financial damage to the economy. Economists now claim that the US dollar could weaken by as much as 15% in the coming 4 to 6 quarters, as inflation continues to subside and the Federal Reserve loosens monetary policy. Unfortunately, it is not impossible for the US dollar to collapse. In fact, the chances of a crash happening only continues to grow as time goes on. The national debt is a primary threat to the US dollar status as a world reserve currency. In 2022, 7.4% of federal tax payments were allocated to pay off interest on national debt. But in 2022, interest rates were still hovering at all-time lows. Fast forward 1 year, and interest rates have risen at the fastest pace on record. A greater percentage of tax payments will be allocated to service interest on debt. As debt levels balloon, the value of the dollar goes down. Another contributing factor to the demise of the dollar is a U.S. trade deficit, which grows when more goods are imported than exported. Sure, it is helpful for consumers who get to buy goods and services at more cheaper prices, but it's not without cost. It's unfathomable to most Americans what the fallout would look like from the dollar no longer holding the position of the world's reserve currency. But you do not have to look very far to see the real effects of a dollar collapse. History is filled with examples of populations quickly brought to the breadline, as their currency is inflated away or canceled in the blink of an eye. Although an overnight event is unlikely to happen, a gradual decline in the U.S. standard of living is a natural consequence of a weakening dollar. You can already see the effects on the working classes when wages fail to keep pace with asset growth. The middle classes get squeezed. A growing number of people cannot make payments on mortgages, student loans, and credit card debt, and then poverty rises. The US dollar has been the official currency for international trade for years now. However, recently, there has been progress on creating a new digital currency, which many say is an attempt to push back the US dollar. The trend among the world's central banks has been to explore the creation of a CBDC, also known as central bank digital currency. The Federal Reserve announced on March 15th of this year that its FedNow service will begin operating in July, and its implementation will have several phases of preparation. FedNow will be the first government-created platform to help your bank transfer money in real time. It is similar to what the private sector has already created through payment apps like Venmo and Cash App that sends funds almost instantly, but outside of bank accounts. Officials say that when FedNow launches, you will be able to make payments on your mortgage within seconds. You will be able to send funds on the due date rather than having to plan several days out for an online payment to clear, or up to a week for a check to be processed. But many are concerned as to how this will affect the U.S. dollar's dominance. Concerns around a central bank digital currency are also centered around privacy, as a digital U.S. dollar would, in theory, eliminate the anonymity associated with cash transactions and create a framework for government intervention into private financial dealings. A CBDC also has a potential to disintermediate commercial banks in portions of the financial system, thereby concentrating more power with the Fed. We know that the move towards CBDCs is gaining momentum, driven by the ingenuity of central banks. Currently, around 100 countries are exploring CBDCs at one level or another, some researching, some testing, and a few already distributing CBDC to the public. In the Bahamas, the sand dollar, which is a local CBDC, has been in circulation for more than a year. Sweden's Riksbank has developed a proof of concept and is exploring the technology and policy implications of CBDCs. In China, the digital e-CNY continues to progress. There is no universal case for CBDCs because each economy is different. In some cases, a CBDC may be an important path to financial inclusion. For instance, where geography is an obstacle to physical banking. In others, a CBDC could provide an essential backup in the event that other payment instruments fail. So central banks should tailor plans to their specific circumstances and needs. Now you should be prepared just in case the U.S. dollar crashes this year. Once a collapse occurs, financial markets will experience much greater volatility, leading to sharper and steeper corrections. The U.S. standard of living will continue to decline, leading to even greater wealth gaps between the rich and the poor. As the middle class is increasingly squeezed, poverty will increase and crime will rise.